everybody. Welcome to TraderMerlin Show. Taco Tuesday, a very exciting Tuesday. The calm before the storm. Tomorrow is a very big day for multiple reasons. Obviously, the Coinbase Ipo. We also have some of the major financial firms reporting earnings tomorrow morning before the market opens. So by the time you guys pull your head off that pillow, it'll all be reported, and some crazy stuff is going to be happening, which will probably be called the popcorn trade of the day. So we'll talk about that a little bit later on during the show, but for today, we're going to talk about something that happened yesterday and today. We've been talking about bond yields and how the issue of this rising yield curve is starting to become a little bit concerning for economies, big businesses, etc., as the cost of capital starts to rise. So today, we're going to look at this topic this topic right here, propping up the bond market. Yes, Brendan is not here with us today, but a quick shout out to Jeff, Les Gold, Sue, Naum, Tom, Shadow One. You're a newbie out there. Hello. Alex, my good friend, thank you so much for all you've done, man. I appreciate it. And Siraj, we're going to have a great show today. Propping up the bond market, and as I kind of said there, Brendan is the anti-Fed here. He was like, oh, God, damn the Fed. Well, they're a necessary evil at this point that's propping up this bond market. We'll talk more about exactly what they're doing with my guest, Mr. Bill Addiss. Bill, how you doing today?
I'm doing great, Merlin. Great to see you. And I missed the dialogues with Brandon as well. I'm sorry he's not here today. He's always fun for the dialogue.
He'll be there. Any opportunity he has to slam the Fed, he is right there ready to capitalize on it. Before we dive into the real deep stuff, I want to start off high level with regards to what happened over the last couple of days. Last time you were on the program, we talked about the 10-year auctions and the 30-year auctions being rather concerning. We have those auctions this week. The numbers didn't seem too bad.
No, the numbers actually were surprisingly good. And just to kind of put it into some context, you're right. This is supply week.
Yeah.
We got a boatload of long-term supply of treasuries being auctioned by the government this week. Well, actually 2 weeks. Between this week and next week, we've got $380 billion of long-term debt beyond 2 years being issued by the government. And most importantly, yesterday we had the 10-year auction, and today we had the 30-year auction. And if I could, I just want to take a step back as to why do we care about these auctions, if I could,
right,
just for a moment. So let me give a little bit of historical context, just going back a month. But in February 28th, we had the U.S. government issued a 7-year treasury. They auctioned it off, and they do that every month. Mm-hmm. But what happened this February is at that auction, we had the lowest level of participation ever in the history of a U.S. treasury auction. You know, we'll talk about it in a moment, but, you know, we actually benefit. There's a lot of people in the world who want to buy U.S. treasuries. So there's a lot of demand. But for some reason, that demand just seemed to disappear last month. And when that happened, and investors, both institutional, global, retail, there was like a mass boycott of that treasury auction. It scared the market. Uh-huh. And just as a result of that one auction results, which came out at 1 o'clock that afternoon, when the news came out that the auction was so bad, the NASDAQ market dropped by 2.6% in a matter of minutes. The Dow was down, I forget the percentage, honestly, but the whole equity market was down. The 10-year treasury yield went up by 10 basis points. I mean, Chicago futures almost went limit down that afternoon.
Right.
So, you know, when we talk about interest rates, it doesn't just affect the bond market. It affects so many other different asset categories. So here we are this week now. The U.S. government is issuing a boatload of new treasuries long term. So the marketplace was real anxious to see, are we going to get good participation or aren't we? Could we get another February event, or will we be able to absorb this supply? And the good news is we really seem to absorb this supply, at least for yesterday and today. We seem to absorb that supply pretty well.
Yeah, when we look at the numbers for the auction, that 30-year, you know, we had a bid to cover ratio in the previous auction at 2.3. We came out at 2.5 this time, so no big deal. Right. And the yields actually were better, not better. The previous was 2.3%. We came out at 2.32, so slightly higher, but I think people were probably expecting a bit higher jump than that. So this is actually maybe a bit calming for our markets.
It was, and particularly, as you said, the big news was today's 30-year yield, 30-year. You hit the nail on the head. And just to explain to the group, the bid to cover ratio says how many more orders did the government get versus bonds they actually had to sell. So a bid to cover ratio of 2.5 means they literally got 2.5 times more buy orders that they actually had treasuries to sell. That's pretty strong demand.
Right.
We had been at 2.3 for the last auction before that. So, it's all about supply and demand. So we know we have a lot of supply coming in. The unknown variable is demand. And this gave us a snapshot that said, yeah, demand looked pretty good. So as a result of that auction today, bond prices continue to trade up. Think of any auction, right? And you get a good auction, prices go up, which means yields have gone down. So this morning, that 10-year treasury was at 1.67 as a yield early this morning. But after the auction, that yield dropped down to 1.62. So we had a 5 basis point drop in longer-term interest rates today as a result of that good auction.
And on the screen for everybody at home, this is the current 10-year yield. You can see right now we're at 1.616. But more, I think what's noteworthy about this chart is how accelerated that move was in January, February, and March of 2020. I mean, it was really like, it's a butt pucker kind of moment, like, oh, shoot, man, we are really starting to spike up here. And now, just for the past, let's call it 3 weeks to a month, it's been sideways, really kind of sticking right along that 1.61 mark, not making a new high. So this is all of a sudden calming the markets a little bit, that the Fed's actions, which we'll talk about here in a second, may be having an impact on it. And this is not going to be getting out of control as a lot of people were forecasting. So there's your 10. Here's the 30-year, which is a very similar picture. Looks slightly weaker in my opinion, because it hasn't made that second high here. But all in all, it's a good sign, because as these yields start to drop back down, that should act as a catalyst for the equity markets, or more so a catalyst, meaning that the cost of capital is getting cheaper, therefore businesses can go out and get loans, etc. So I want to real quick make one comment here. And Tom, you sent in some great comments and questions, and he goes, look, every time we have Bill on the show, great content, but I don't see anything that's actionable and tradable. This is designed to be that 30,000 foot level. And remember, what we're looking at here with bonds, I'm never going to say, hey, go out there and start trading bonds actively. It really wouldn't do it unless you're trading an ETF like TLT or something. What this is, this information of the yields curve, bond auctions, that's really describing the motion of the ocean at that moment in time. And the ocean is the piece that can really create huge swings in the equity markets, or all markets for that matter, over an extended period of time. So this is that macro view. Yeah, unfortunately, we won't be looking at any charts saying short right here, but it's saying, look, these might be potential long-term setups for you guys going forward. So for those who are investors, this is critical stuff. For the day traders, they would say in Italian, ma chi se ne frega, means who's going to care?
Right. Absolutely agree. But if I could take it from the high level down just a little bit relative to the conversation we were having a little bit before the session began, we're talking about the yield curve is now much steeper than it was, right? We used to be inverted.
Yep.
Now the yield curve, we've got short-term rates low, long-term rates high, and have been going higher for the last 6 months. So if I can just translate that to maybe a little bit more of a macro level, when you look at the normalization of the yield curve, one of the industries that is best opportunistic to take advantage of that is the banking sector. Mm-hmm. In other words, as we have gone from an inverted yield curve to a normal yield curve and rates continuing to rise, the banking sector will and continues to benefit from that. If you look at the performance, for example, of the XLF, it has done wonderfully even relative to the other sectors. So I do think, if I can bring it down a little bit, as we look at this yield curve shift that we're seeing, I do think there's an opportunity in the bank and finance sectors here. They're going to benefit from that. Obviously, commodity prices also have an upward bias. The trend is on the upside when interest rates go higher. So, there is, if we had time, and we do this in the signature class, for example, let's talk about, okay, this is what's happening in the ocean, and I like that. How does it affect different asset classes? I mean, that's a very important conversation.
Yeah, it's one thing. When I initially started trading, I was exclusively equity, stocks only. Matter of fact, I was short-term day trading stocks, and that is like, okay, you realize that has the ability to be a very fast-moving piece, and there's lots of trading opportunities. And then as I started to learn about futures and Forex and options, and ultimately bonds and cryptocurrencies, you realize it's all this giant machine. For me, the biggest mover on the macro level is the bond market. And some would argue that it's currencies, but I still think currencies are somewhat free-floating, right? There is some manipulation going on there, but the bond market, to me, as John O'Donnell would say, is the mother's milk of capital. Understanding those trends and the moves within the bond market, I think, give you a great long-term perspectives of where things may be headed. And, we're in a transition period because the Fed, if they didn't step in and aggressively start buying the long end of the yield curve, the 10s and the 30s, we would have seen this getting much steeper, which could have posed systemic risk.
No, the Fed continues to be the single largest factor in the market. Even when we say the Fed is doing nothing now, it's just not true.
Yeah, right.
The Fed is a big buyer in the market. Excuse me. So, the Fed is technically, they say they're on hold, waiting to see what the stimulus package implications will be economically. But the Fed, they bought the 10-year auction. They bought the 30-year auction. The Fed's in there buying about $120 billion a month just on keeping their portfolio at its constant size.
Mm-hmm. Now, do you see any change with regards to what they're purchasing? So, for example, we know that they were really loading up on the short end to keep that thing pegged at zero.
Right.
Is there now a backing off on the short end, so we might potentially see that rise a little bit, and then focusing predominantly on the long end, or what can we expect there?
Well, that's a great question, by the way. I do have to put that into some context. The $120 billion a month that they're investing in the market is just getting their cash managed. I mean, literally, they've got interest payments coming in, bonds are maturing. There's no policy statement here. So as a rule, you're absolutely right. They have been focusing more on the short end. Now, what we might expect to see happen next. Now, here's the might. Predicting the future with the Fed is dangerous.
Very.
But if long-term rates start going up too fast, too quickly, and I would point out, a steepening yield curve is the bond market saying they see good times ahead for the economy. Mm-hmm. I do want to point out, whereas the bond market was predicting a recession when the bond market went inverted 2 years ago, right now with our normal yield curve, the bond market is saying good times ahead.
Yeah.
I mean, that's positive news. But remember, the Fed doesn't want too good times. We don't want things to be too strong.
Roaring 2020s again, right?
Exactly. We were trying to avoid that. So in an effort to dampen down that yield expectations, it is quite possible that the Fed could start concentrating more on buying long-term paper because the short-term market's already at zero. How much are they going to affect that? Right. If they really want to have impact, they will start buying more long-dated, longer maturities. And then the other thing they can do is, and some of your listeners might remember this back from 2010, something called Operation Twist. Mm-hmm. They have the largest portfolio in the world. Our Fed has $4 trillion worth of treasuries that they bought. Well, they could constantly be changing the maturities of that portfolio. In other words, if they really wanted to impact long-term interest rates, if they wanted to do yield curve manipulation, as we call it, right, well, they could sell their short-term treasuries and replace it with longer maturity treasuries, driving down those long-term yields. Now, the good news is our Fed is so transparent these days. I mean, I know we have a lot of cynicism about the Fed. People question it. But the reality is the Fed today is more transparent than they've ever been. Even now they're giving us forecasts out to 2024. So, if the Fed is going to do an Operation Twist, they're going to tell us. Mm-hmm. They're going to let us know because they want the market to react to it. They love jawboning. They love telling the market what they're going to do. The market then reacts, and sometimes they don't even have to do it.
Right. Yeah, understand.
So this won't be in secret. If they start doing some yield curve manipulation, we'll know it.
Yeah. Yep. Jerry is questioning Forex markets. Yes, Forex markets are bigger than the bond market. However, if you look at so obviously the Forex markets is the purchasing power of your currency. If you look at what the bond market is, though, it's the cost of capital. So, you look at somebody like a corporation, let's say Apple, right? Apple has cash. They got, I think, $70 or $80 billion sitting in cash. But if the cost of capital is cheap enough, what happens is Apple will go to the bond market, they'll issue some debt, and they'll raise capital very cheaply. So the bond market, to me, is almost more, and I know we'll get back and forth on this from the Forex traders. I think personally the bond market is a bit more powerful because it almost dictates what businesses can do and how quickly they can grow their business. Whereas if the dollar's dropping, okay, there's import-export issues, but it's not hitting them smack in the face of, this is costing you capital. So when I say that the bond market is more powerful, that's all I'm referencing. The size of the market, Forex is clearly bigger than the bond market and the equity markets probably combined. Yes, no argument there.
Right. Although I would pay, and you're talking to a bond guy, so I'm only going to be a commercial for the bond market. I mean, I've been 40 years of bonds, but I would point out for people who are not aware, even just here in the U.S., the bond market is substantially larger than the equity market. Mm-hmm. Just looking at the U.S. market, and that relationship is the same globally, no matter where you look in the world. The debt market is bigger than the equity market.
Right. Yep, absolutely. Question from Medic Man Down. He says, Bill, do you think the Fed will ever let a natural correction happen? That's a good one.
A natural correction to what market, I would want to ask him. The Fed says they don't care about the equity market. We know that's not true.
Right.
So, when you say natural correction, I'm just not sure what market we're talking about. I mean, directly, the Fed can't affect equities. Now, they do affect equities because they affect bonds.
Right.
So I'm not quite sure when you say market correction. I personally feel the equity market is way overvalued. That's just my opinion, but I'm not sure when we say market correction what we mean.
Well, I think what we're talking about there, and my quick answer to that one is, Medic, not a chance in hell will they let a natural correction happen. I think what a natural correction he's referring to is where you don't have all this intervention. It's basically saying, oh, the markets are crashing. Let's let the markets do what they do. Let's let a free market economy fix itself. No chance in hell.
You can't put toothpaste back in the tube. Our Fed is proactive. Our monetary policies are proactive with stimulus packages from the government as well as quantitative easing from the Fed. No way in hell is that, pardon me, no way can we expect that.
Yeah.
We have very, very proactive fiscal and monetary policy. You might not like it, but you have to admit it is extremely proactive.
I hate to say it, it's almost like it's very a sensitive topic, but you have all these people saying defund the police, right? If you believe that blanket statement, you're basically saying give a free rein to all criminals out there. If you defund the police, what you end up with is a system that's chaotic. And while in principle you're thinking that some police organizations, some police officers, not all of them, but a few, are very bad apples, that's not a good representation of the whole. With regards to central banks, we could look at them as being, labeled as the bad, nefarious actors, right? Like, oh, these are dangerous people. We got to abolish the Fed. If we didn't have the Fed and we let a free market economy, which I kind of want to see happen, our downtimes would be really bad. So, for example, that financial crisis in 2008 when everyone is screaming and saying it's the worst ever, it would have been 10 times worse than that. I mean, it could have gone on for years until the market fixed it. Now, would we be better in the long run if systemically we fixed ourselves organically? Probably. But it won't happen. So, as much as I hate the Fed, thanks for kicking that market back into gear in 2008. I really think you might want to cool it down a little bit now, but hey, I'm not on the board, so.
No, I view it kind of I've had to tell you because I do have to say it legally, the Fed is a client of mine.
Yep.
I train at the Fed. The New York Fed is a client of mine. And I share the same concern you do, and I share it with them vocally. It's almost like a necessary evil. Yeah. I also like the fact that the Fed is autonomous. I don't want the Fed being a part of the government because I don't want our elected officials screwing that up also. Right. So I like the fact that the Fed is autonomous. So, I mean, there's pluses and minuses, but this is the system we're dealt with. This is the system we're working with, like it or not.
Absolutely. And I knew I'd get ruffle some feathers out there, but with the defund the police. And the reason I brought that up is that's a perception that most people have, is that it's saying get rid of all police, which, of course, would be a fool's errand, and we wouldn't want that to happen anyway. But anyway, we'll move on from that discussion because we'll try not to make it political. All right. You had some great charts I wanted to get to. There were a few that were really noteworthy. So the first one I think that's noteworthy for me anyway is that yield curve. Now this is the most recent one as we are today. It's starting to look better and better, at least better than it was about a month and a half ago, right? We're starting to see that 10 and 30 at least stabilize and not accelerate to the upside.
Well, and honestly, Merlin, I wanted to question something you said earlier because it seems to me you're adding a bias that these higher long-term yields are problematic.
Right.
Or you're worried that they need to stop.
No, I'm worried that the acceleration is it's happening so fast.
Very quick. And honestly, for the next class we do, I want to show you a chart of the inversions. Every time we've come out of an inversion like we did this time, the rate of acceleration of interest rates is just remarkable. When you actually look at this recession and the rise in interest rates coming out of the recession being so dramatic, don't disagree with you at all. But if you look, that's been the case for the last 7 times.
Is that one of the charts that you sent me, the chart of inversion?
No, unfortunately, this is coming up in subsequent conversation, but I'll send it to you so we can follow up another time.
No, it's perfect. I'm scrolling through your charts going, did he send it to me?
No, you just reminded me, though, because your observation is 100% spot on, but that's always been the case when we come out of an inversion. Because many people are asking, the question I get all day is, well, how high are rates going to go?
Right.
And obviously, I'm not clairvoyant, but I do have to continue to say the supply and demand situations that got us here. If you go back 6 months ago, the yield on the 10-year Treasury was 0.5%.
Right. Yep.
Now we're at 1.65 or 62.
Yeah.
I mean, these yield increases have been absolutely dramatic, but I do think the whole supply and demand situation that got us here is going to continue.
Yeah.
So I really don't see. I know we've obviously, from a technical point of view, we've got a consolidation here. We're hanging out around 1.5 to 160 as the yield on the 10-year for the last couple of weeks. But I think after that momentous move we saw, that's just a period of consolidation.
Yeah, for the next leg up, man.
I do. I think what got us here is going to continue to be what's going to continue to drive rates higher. Now, again, you could have the point where the Fed's going to then step in and say, all right, too much, too soon, too quickly. But I still think the bias is on the upside here. And not that they're God, but Goldman Sachs recently came out to their institutional clients saying that, 2% is where things are going to start slowing down the next time. Mm-hmm. So on the 2% yield on the 10-year is where things should, start consolidating again.
Well, we're almost there. I mean, we're pretty damn close.
Yeah, we're only 38 basis points from there, so we're getting pretty close.
I just had a chart up there. One of the things I find interesting is in this period of time where we have such a cheap cost of capital. I mean, it's almost free money if you think about the interest rate yields. Why are we seeing such a spike up in global corporate defaults on debt? I mean, you would think that it would be actually very easy right now for them to meet their debt obligations. To me, that is a warning sign.
No, it is. And it's funny you mentioned that because I just posted on LinkedIn an article from Forbes this month. The credit market author for Forbes is a good friend of mine, Myra. And she's talking about the corporate credit bubble that is developing. Mm-hmm. And you just hit on it. And it comes right back to what you said. And if I could actually give you the real numbers, because it's part of one of my classes, Apple in January came to market with $2 billion bond offering. They borrowed $2 billion.
Like they need $2 billion. I mean, they got $78 billion in cash, but I need two more.
More than that, triple that number. When Apple came to market with that bond, they had $226 billion of cash and retained earnings. I mean, Apple is an asset management company that sells some technology on the side.
Yes, it is.
They're managing a $220 billion portfolio. And even with that amount of cash on hand, they issued $2 billion in bonds in January. Mm-hmm. Why? Because the cost of capital was so low.
Right.
They borrowed that money and only paid a 2% interest rate. That's phenomenal.
Yeah, right.
And so Apple's attitude was, looking at this on a historical basis, 2% money is so cheap, let's load up the boat. Mm-hmm. So they borrowed $2 billion, literally not even needing it. And their logic is, as long as we can get a return on equity
that's greater than 2%. Yeah.
And I would remind you, 2% interest on a bond is a tax deduction. Corporations get a tax credit on interest payable.
Nice.
The government's even going to subsidize it. You don't get a tax credit on dividends, but you do on interest as the issuer. So it's a tax credit on top of it. Disney did the same thing. I forget how many tens of billions of dollars they had. So we've got corporations are leveraging up their balance sheets. I mean, the number that blows me away, if you look at all of the corporate bonds in the U.S. market right now, it represents an equivalent value to 50% of the country's GDP.
Wow.
Now, if you go back only 10 years ago, the entire corporate bond market in size was about 16% of U.S. GDP in equivalent value. Now we're up to 50%.
Wow, that's incredible.
At a time when bankruptcies are increasing.
Yeah.
Thanks to the pandemic, we've got a huge problem here. We've got industries that are still closed. We forget about that. We've got whole sectors of the economy are still closed. Carnival Cruise Lines, I was mentioning it in the XLT class today. Carnival Cruise Lines has had to issue 4 different bond offerings just to stay alive over the last year. In their last bond offering, when they had to move the timetable for getting ships out on the water until after July, and they had to move the timetable, there was Carnival within a day in borrowing more money. They're a junk bond by every definition.
Sure, absolutely.
They're trying to stay alive, but they had to pay 10% to borrow money in the corporate bond market. And their logic is, we don't have a choice.
Yeah.
We got to try and stay alive. So we've got a lot more credit risk coming into the market. But unfortunately, the credit spreads, the yields you're getting on corporate bonds now is as low as it's ever been. It's at a level that is pre-pandemic.
Yeah, I've got that chart up here. So what you're looking at, that blue line, guys, is the investment grade, and then the high yield is going to be the red line, which obviously you would expect there to be a bigger spread. But you're right. If you look at what we were back in December of 2019, we're pretty much right back down to those levels after that colossal spike up in 2020, early 2020. So this obviously would be one of those things that calms you a little bit, right? Because the spreads are pretty tight, meaning it's very competitive and not out of line.
It also means, honestly, and I'm not here to be a commercial, it's hard to pardon me, slow down, but I get really excited about this, I'm sorry. It's hard to recommend corporate bonds right now because the absolute level of interest are so low, particularly if inflation's going up, but the yield you're earning relative to treasuries just isn't compensating you for the risk that you're taking. Mm-hmm. So it's real hard for me to kind of recommend corporate bonds at this point.
I feel like it's hard to recommend bonds, period, but
Well, we're going to, in a further conversation, though, Merlin, we got to have a tips conversation.
Yes.
Because if inflation is going to go up, there's an opportunity here.
Yeah, and again, we talked about that yield curve steepening, and then you get, for those who don't know, tips are a bond product that will adjust the yield. So in a dropping rate environment, they're not the thing to hold. In a rising rate environment, tips are probably a better way to go if you expect rates to keep going up. And at this point, yeah, I do think that probably is a safer bet if you're buying bonds for a portfolio.
Right. And I just want to clarify or specify one other thing. Tips could be an appropriate investment if you specifically think inflation is going higher. Mm-hmm. Because the value of tips is pegged to the inflation rate. So if you think inflation is going higher, that would convert to an opportunity with the tips product.
Right, and we talked about this a couple days ago when we had the PPI numbers come in showing a 4.2% increase year over year. You saw something similar, not quite 4.2%, but it's above 2% on CPI numbers, which came out a little bit higher than expected today as well. So, inflation it's not, full on busting through the door, but it's basically peeking over going, hey guys, you miss me? I'm here. I'm starting to warm up.
And this is now 2 months in a row of problematically high numbers.
Yeah.
That CPI number today was the highest number in 8.5 years, year over year. Now, remember, we're comparing it to last year when we were in the pandemic. But, on a gross number, 0.6% for 1 month on CPI and 0.5% on PPI for 2 months in a row, higher than expected. People are starting to worry about inflation. And what that means is we don't know if the Fed's telling us the truth.
Right.
That's what it comes down to today. The Fed has told us we're not going to be raising interest rates. With unprecedented clarity, they've said for the next 2 years, we don't expect to raise interest rates. But the market doesn't believe them because the marketplace is justifiably afraid of inflation. And if inflation does start becoming a problem, and the last 2 months might indicate that, realistically, the Fed's going to have to start raising rates.
Right.
They're going to have to in an effort to curtail that inflation. So the Fed's telling us what they believe. We just don't believe it. And maybe we shouldn't.
Yeah, well, and I agree. That sparked a discussion here in the chat. Yes, I think we'd all agree that inflation is here, just not to the extent that the Fed would say they're worried about it, right? Inflation is pretty much ever present. But do we all believe that it's under the 2% target? I personally don't. I think it's higher than that. I think it's lies and manipulation of data. My guess is we're probably somewhere in the 4, 5, 6% inflation range. But hey, you know what? I'm not the one making the statistics up. It reminds me of an old joke. The accountant walks into the CFO for a new job and he's saying, hey, look, I'd love to be the CFO of the company. And the CEO says, well, here's a simple math equation. 1 + 1 = what number? And the accountant says, what number do you want me to make it say? And that's pretty much what I feel like all these analysts are doing with regards to CPI, PPI, et cetera. But yeah, I definitely think it's much higher than it's higher.
Well, we can have no inflation, Merlin, but in 5 years, your Pepsi can would be a 1 ounce Pepsi can.
Yeah, it's a shot glass.
Right. Exactly. I like your Pepsi can theory.
Yeah, that's a good one. All right, what else I got in here? So... Well, how much time we got? I'm trying to shorten these shows. Medic says, so if there was a Venezuela hyperinflation, would tips work or buying physical gold or silver be better? Great question.
Great question, and I don't want to compare it one versus the other because you've got differences in liquidity, you've got differences in credit risk. Both of them are considered to be havens of safety. Yep. That's the important point. If, God forbid, we get to that type of scenario, both will do well. I might say that gold might be a better asset because if we go into a hyperinflationary period, there is credit risk to sovereignties.
Yep.
U.S. government treasuries used to be AAA. We're now AA. Europe and France is triple. Germany's triple. So there is such a thing as sovereign risk. If we here in the U.S. were to go into a hyperinflationary period, it's going to affect the value of our currency, our sovereignties, and we could be downgraded.
Right.
So if you're getting that calamitous in your catastrophe, maybe you don't want treasuries from the U.S. government. You'd rather have gold, but that's a pretty extreme scenario.
Yeah, and actually a question was coming up about Zimbabwe type inflation. I don't think we're going to ever get to that level of inflation. We've got too much government manipulation going on to let that happen. But if we do go into an extended or heightened area of inflation, I agree. I think tips are probably good. I think bonds, commodities are going to be great, gold. Right. And I would, again, be doubling down on cryptocurrencies as well because the lack of ability to inflate those with regards to supply, right? You have a fixed supply on those things as well. Since Brandon is putting your class dates out there, tell me a little about your class. And I guess it's going to be May 4th to May 6th.
Yes, thank you. We've got the we rolled out August of last year, continued involvement with me and OTA, and I'm doing a signature series, a 3-day class called Bond Aid, which is an extension of this with a lot more product training. We talk about how to trade ETFs, how to buy bonds, but yeah, that 3-day signature series is those days in May. And then also I'm doing a monthly XLT class, and I just did one this afternoon with the community. And my next XLT is on May 11th. So that's a 2-hour session. And we decided on that when we were going to get into mortgage-backed bonds and some of those package products that got us into trouble that are still getting us into trouble. So we've got the monthly XLT, next one on May 11th. And then the last thing I'm doing is the showcases for the signature series. If people check their calendars once a week on scattered days, I do a 1.5 hour session that's taking content from that signature series and getting it out to the whole community. So those are on the schedule too. So a lot going on with OTA these days.
Good. I love to see it. He's doing all kinds of stuff. For those that might not know his background, he is doing he's teaching for the Federal Reserve, so no booing or throwing tomatoes. Good news, it's virtual, so we don't have to worry about that. But it's interesting seeing things from the institution side and someone who's got such a long pedigree of experience. I had one other thing I wanted to ask you, which was about the bond auctions. I'm fascinated by legacy markets, open outcry type of markets. So at 10:01, bonds go, the auction starts. What is this process like? I mean, when I think of like an open outcry, I'm thinking the floor of the CME, and I got people screaming, yelling, throwing hand signs, and elbowing each other. Was it orderly? Like, walk me through. You're running up to the steps of the Fed. How did this work?
I'm literally going to show you how I started the business. I can't believe you asked that question because many people who know me would be hard-pressed to believe. I was actually hired by Lehman Brothers for physical prowess.
Wow.
Because I was a runner. In high school and college, I was a marathon runner. And I was hired by Lehman Brothers because the auctions would take place every day at 12 o'clock at the New York Federal Reserve Building on the second floor. And what I would do is I would go to a payphone. This was before the days of cell phones. I'm going back 40 years. At 6 o'clock in the morning, I would go to a payphone in downtown Manhattan, and I'd sit there for 6 hours in the payphone. At 1 minute before 12, my trader would call me and give me what Lehman Brothers was bidding for that auction. And I would put it on a piece of paper, and I would literally then sprint 3 blocks through lower Manhattan, run. Now, at this time, we had 40 primary dealers who were all bidding for these bonds. So there were 40 other young men, pardon me, but it's sexist, but it was. We would all be descending on the New York Federal Reserve Building, running down the street. We'd run into the building, elbows are flying. They would literally cordon off the corridors so that we could run into the building, 40 of us, run up to the second floor to get our bids timestamped by 12 o'clock. But this is a blind auction.
Okay.
Only the house gets to see what everybody bids. So all 40 firms would give their bids by 12 o'clock. And this process is what we call a Dutch auction. If you or your people are familiar with this, we auction off the treasury, we auction off the product, but ultimately everybody pays the same price.
Okay.
It's a homogeneous pricing model.
I've heard of a Dutch oven, but a Dutch auction sounds a bit different.
This is a Dutch auction. We just do preferred stock if anybody's into the preferred market. Now, in today's process, and by the way, I got run over twice doing that. hospitalized once as I was running through the streets of Manhattan with my piece of paper to get Lehman's bid in. I got run over twice during my career. In today's world, it's all electronic.
Right.
I mean, literally, we sit there and there's a system called GAS where every dealer puts their bid in electronically, and the Fed gives us the results an hour later. So there's no more young kids running through the streets of Lower Manhattan. But it is an auction in the truest sense of the word, and they publish the results.
Interesting.
So we know what firms bid, how many of the treasuries they bought. It's really open disclosure afterwards.
I love it. It sounds. I was just picturing you sitting in this phone booth for hours. Did you have like a Superman shirt on? So you could sitting in the phone, and then the phone rings and you sprint the thing just to get your stamped. Yep. Such a weird profession.
I would even tip the deli to get open early so I could sit there, because the reason I wanted that phone booth, it was one of the closest to the New York Fed. So by me sitting in that phone booth, I was giving my trader a few extra seconds, because you want to submit your bid as close to 12 o'clock as possible. You don't want to throw your bid in an hour early. The market could change.
Right. That is hilarious.
To that last possible second to get their bids in. Now it's all done electronically.
Oh man, I would love to have seen that. I picture that as a scene from a movie. Maybe one day we'll have to write that character into something. That sounds pretty awesome.
I understand there are some old films. This is all pre-YouTube or any of that, but I understand there are some old films running around.
Well, it has to be pre-YouTube. You're sitting in a phone booth. Most of my viewers are going, "What the hell's a phone booth?"
What's a phone booth? Exactly.
All right, hey Bill. Well, thank you so much for coming on. I always love the bond updates. I hope that you get a full class May 3rd through 6th. For those that don't know, he's teaching classes for Online Trading Academy. He's also teaching for the Federal Reserve, but you probably can't get into the Federal Reserve classes. Just going on a limb and saying that. So if you want more information, contact Online Trading Academy. Hopefully you can book your seat for his signature series May 4th through 6th. And if you're in the XLTs, check him out. He says his next one will be May 11th. So awesome. Well, hey, thank you so much. Appreciate it.
Always a pleasure, Merlin. Always a pleasure. Be well.
All right,
thanks to everyone. Be well.
Guys, that was Bill Addiss giving us some insights into the bond markets. As you can tell, he's been doing it a long time, got some great experience out there. I could just pick that. I'd love to see that happen live when all of a sudden you see all these young runners just sprinting down the street trying to get their tickets stamped. That's hilarious. I didn't think it would work that way. I thought that the bond markets or the equity markets or in futures markets were amazing. The way you had hand signs and all that screaming and yelling, but this is just a totally different ballgame. Pretty fun. Okay. Again, hope you enjoyed that one. Again, if you did, if you are new, hit the subscribe button. If you like it, give me a little thumbs up. I'd appreciate that. I'm going to go and let's see if I can bring up some. I think I might be able to get to. I had them here. Where are they? A couple listener questions. This is one I'm going to real quickly go to. Where is it at? Sorry, guys. I've got all kinds of different things going on here. This is the one I want. The VIX. Landis, down in Singapore, sent this one in. Landis, thank you for continuing to listen to the show. I'm surprised you haven't gotten sick of it yet. And by the way, Alex, you are more than welcome to play this show anywhere. Anything I can do to get more PR for the show on eyeballs, you can absolutely. If you want, I'll even do a special show for your team. How about that? I'm happy to do it. I'll stream something live for you if you really want. Okay, so Landis says, with VXX, which is a VIX derivative, it's a short-term VIX volatility index, guys, an all-time low, and fear it cannot go to zero. We can sell at the money put with the intention of getting exercise. Okay, now if you have something that is in a pronounced downtrend, it obviously becomes a little more dangerous to be selling puts because the odds are likely it's going to hit that. Now what Landis is doing here is making a very simple mistake, and I'm going to correct that one right now, Landis, and you'll go, I get it. You ask yourself, how low can a security go? The answer is generally zero. That's not necessarily true. I mean, yes, the floor is zero, but you're looking at something and it's approaching zero and you're thinking it can't go to zero. So it'll find a base, it'll find some demand, and then it'll bounce back up. What they will do is they'll do a reverse split. So say, for example, you're trading a stock and it's now down to $5 and you're like, oh man, this thing's not going to go any lower. Someone's gonna step in here. It's a deal at $5, and let's say there's 10 million shares available. It's at $5. What they will do is they'll do a reverse split, and they'll do a 10-to-1. So all of a sudden, there's gonna be the share price will be $50. It'll be $50 per share with the same amount of supply. So you tweak the numbers, you modify things. So let's look at VXX here, just so you guys can get a better picture of this one. Actually, not with the same supply. Here's VXX, right? And you're looking at it going, man, this thing it's at all-time lows. It's at $10. it's going to bounce. No. Look, take a peek at the weekly. Actually, how about the monthly? And you can see that they have modified this already. They've already done reverse splits on this bad boy. .m. Right? How do we know? Well, I mean, of course, it's not going to give me all the history here. Why is it not giving me all the history? I looked at this one the other day, and you can definitely see the splits. Let me bear with me as I try to bring up a different charting platform because TradeStation is not giving me the data I want. So let's go to VXX. All right, and we'll go to the monthly time frame of this one. And I said same amount of shares. That's not true. It's maybe 10 times more shares. So here you guys can see VXX. It was never trading at $120,000 per share, guys. They've just reverse split this over and over and over. And I might be able to, if I'm not sure exactly how you do it on TradingView, but I think I can actually add in to show me the splits. Let's see if I can add in splits. Let's see, max split colors, split screener, no, split adjustments. Oh well, unfortunately I don't know how to do that off the top here. Earning splits and dividends. Let's see if that did it. No, not seen it. Anyway, you can go in here and you can add in to show you where the splits happen because this reverse split it over and over and over and over again. So if it gets down to $10, they'll do a reverse split. It'll all of a sudden jump up to whatever, 100 shares. They do a 10-to-1 reverse split, and now there's going to be 10 times 1/10 the number of shares out there. It's just manipulation. So I would not go off that fallacy that if you buy something, it can't go any lower. It can go lower. They'll just do a reverse split and jump price up. Am I bidding up VIH in after hours? Is it going up in after hours? I haven't even looked at it. I'm not too concerned with it. It's a longer term one. Long term for me. What else do I got? Should be fun. Right? I would love to see. And actually, it's funny. Bill said he's coming out here in another month or two, so I'm hoping I can knock back a few beers with Bill and talk markets. Yes, similar to the VIX, but remember the VIX is your actual index, so it's going to be a little bit different there. The other one is a derivative. So the VIX is like the baseline. VXX is a derivative of that. Okay. So it's not quite the same thing. Have I seen 13 connective green candles on SPY for? No, I have not. Yeah, you talking daily? It's been phenomenal what we're witnessing right now on SPY. You know, and it just keeps on going. I mean, you're just basically up every single day. Well, green candles. It's not up every day because we've had a couple, gap downs, but it is a pretty amazing run going on right now. One more positive note. Yes, Big Eb. On a more positive note, Bitcoin, Ethereum, all-time high. Not only that, but check out what happened with Ripple. I mean, we talked about Ripple a bit. I mean, this is just a phenomenal run. Then you have the crap coin Doge hit all-time highs today, up 29%. But, Bitcoin's up 5% today. I like this one simply because we addressed this pattern early on, right, which was this ascending triangle. It's making this series of higher lows and it's making about the same highs. So this is an ascending triangle. I would make the contend that we broke that upside, which means we should see a pronounced run here, right? A bigger move to the upside here in Bitcoin. But all in all, cryptocurrency is looking absolutely phenomenal. That's Ethereum, which also broke through those highs, but it did so a couple days ago. Today was a big move for the cryptocurrency world. And again, I talked about why I thought this was going to happen, and it really has a lot to do with the Coinbase IPO, which, of course, for tomorrow, guys, is the big story. Now, let me show you a couple other things that are going to be happening tomorrow, which could be noteworthy, and I think we'll start right here. You start off early in the morning. This is before market opens. JP Morgan, Goldman Sachs, Wells Fargo, Best Buy, Shaw Communications, all looking at earnings before the market opens. Actually, Shaw's after market close, so you see the BMO here. So this is big. I mean, you have three of the biggest banks in the United States and potentially in the world reporting earnings tomorrow with JP Morgan, Goldman, and Wells Fargo. Now, as Bill mentioned, they like a rising rate environment. It means they got more profit margin. So it's a good thing for these financial firms. We've seen XLF continue to rally up and look strong. This earnings season, though, at least for this quarter, my biggest area of interest isn't necessarily are they posting earnings or how they're posting earnings. It's what are they adding to their balance sheets. Predominantly, I'm looking at Bitcoin, right? I actually heard something today that there's a rumor that Walmart has added $1 billion worth of Bitcoin to their balance sheets, but we don't know. We'll find out when they release their earnings. So Tomorrow, we'll find out if JP Morgan, Goldman Sachs, and Wells Fargo have been dabbling in that space. And not just Bitcoin, it might be other digital assets. Maybe they're trying to corner the market in Ripple or some of these other cryptocurrency digital assets. So it'll be very interesting for me to see how this all pans out this earnings season. That's the big stuff for tomorrow is, I didn't even have that earnings calendar up there. There you go. This is the big concern for tomorrow is what are they doing with their earnings, of course, for our overall market, but then the crypto side of things. Now, the biggest news for tomorrow is going to be that Coinbase IPO, which we will make a very quick prediction here. It's going to look like that all day. Big swings up and down, making it the popcorn trade of the day. Yes, that's right. I don't use the popcorn trade of the day graphic too often, but I thought, why not? Because I paid to have those graphics built, so why not use them? What is a popcorn trade of the day, for those that might not know? That's where you literally look at something, you put your feet up on your desk, and the reason you put your feet up is so your hands aren't near your keyboard. You stay away from it. You do not trade COIN tomorrow. Just be careful. It's going to move way, way, way too much. I have a feeling that there's going to be a lot of people that get whipsawed and lose a lot of money on tomorrow's coin action. My guess is it will be pumped up to ridiculous highs over the next few days. It might come back down to a more reasonable level where if you are a long-term investor, you could buy and hold it for some time. But let the chaos filter out of the market because right now it's the most talked about thing out there. So that's your popcorn trade of the day. I will be eagerly watching that one because, as you guys know, I'm buying VIH, or I've bought VIH. I'm in VIH, which is nowhere near the size of Coinbase with regards to what they do, but they are another exchange that is basically going to be going public. So this is, for me, and anybody here who's a crypto lover, a pretty important thing. Why is it so important? Because Coinbase represents the first major crypto exchange that is going public. For me, personally, there's no turning back now with regards to crypto. Once the SEC and regulators let Coinbase come to market, you now have all sorts of big money backing Coinbase. They can't go, hey, we're going to shut that down, end crypto in the US. To me, it opens up the floodgates of legitimacy for these digital assets. And I think you'll see more money pouring in, which is, I think, why we've seen such huge moves over the past 48 hours. Actually, last week, we talked about it last week as well, where I said, look, I think going into the announcement, it's going to be a big surge in crypto assets, which I think it runs on the heels of the legitimacy that the Coinbase IPO brings. I don't know that one, Brendan. I don't know, RSX. Yes, I agree. $100 billion market cap on Coinbase, most likely. Probably. Okay. Probably. So, I think I had one other thing to talk about, then I actually get to wrap it up before. Man, I was going to shoot for a half hour. I just can't do a half hour show with you guys. It's unbelievable. Here is your economic calendar for tomorrow. Now, not a lot of super movement stuff, but I did have a couple things on here that are noteworthy. Crude oil inventories, obviously, we had a little nice move up in oil, but it's still stuck in that sideways range. But then it's all about the Fed. You got Powell speaking, the Beige Book, Williams, Clarita, and Bostic all speaking as well tomorrow. For international markets, there are some big pieces of data. Australia, in particular, coming out with their unemployment rate, and then you have some consumer price information coming out for the European Union, primarily Germany and France. That will happen late after the show tomorrow. So there you go. I think it's it. Am I done? Just come half hour early. Well, that will do it for me for today, guys. I have a couple questions that I wanted to get to that I didn't get a chance to get to. One in particular is talking about scaling into positions was one of the questions that came through. Another gentleman was asking about, actually it was Tom was asking about, pulling his money away from producing assets like FANG stocks, ETFs, cryptos, covered calls, or option plays to buy into the bond markets. And I probably could have dovetailed a little bit of today's conversation there. And then I'm actually going to walk through a little bit of Coinbase tomorrow. We'll see if they're not shut down. But Karen sent in a couple of questions. Wondering about order flow, how you send these things back and forth. So I might do a little bit of a segment where I'll transfer some funds back and forth, show you how to move these currencies around, also how to place limit versus market orders, and read that order depth book that they provide for you on Coinbase, which a lot of people are a little bit confused with that one. Also, I'll be sprinkling in a little bit as we go forward about yield farming and liquidity pools. These are two things that if you are in the digital space, you got to know. If you look at bonds yielding, 1.6%, there are digital assets that are yielding 50,000% a year. I know it sounds crazy to say. Obviously, the risk is just off the charts with these, and I wouldn't touch them with a 10-foot pole. But I do have a 20-foot pole that I'm going to put about $1,000 on and be playing with those markets just to see, and I'll let you know how that all pans out. But there are some great ways to get rates of return that are going to eclipse anything the bond market can provide you by taking minimal risk, such as staking and yield farming, which is a very new topic out there that most people haven't heard of. So I'll be sprinkling on a little bit of that as we progress over the next couple weeks. Okay, no crypto talk tomorrow? Good luck with the Coinbase IPO, brother. I won't talk about it on Thursday or Friday, but I got to talk about it tomorrow. Mike says Coinbase IPO set at 250. My God, I remember a couple weeks ago it was supposed to be 100 and something, and now the numbers I'm hearing are 350 with regards to expectations. Someone threw out a 600 figure. Who knows? It's going to be wild, so just be careful. I can sneeze without mentioning crypto. I absolutely can. But, when people ask me about it, I want to answer their questions. So there you go. Neener. All right, that'll do it for me, everybody. Hope you guys enjoyed today's show. If you like Bill Addiss, make sure you check out his signature series. That is going to be May 4th through May 6th. They got a 3-day class with Bill Addiss. You can find out more information by going to tradingacademy.com, or if you are a graduate, just contact your local center, see if there's some spots available. He's also in the XLTs on May 11th. But for those of you who are in Online Trading Academy, just go to your MyOTA and check your calendar, type in Addiss, and I'll tell you exactly when he's going to be there. All right, that's going to do it for me, everybody. Hope you have a great day. I will see you for our crazy earnings season kickoff and Coinbase IPO tomorrow. Take care.